What is an escrow and how does it work? Last week we went over into a little bit more detail of some of the other things, but we're going to bring it back down to basics. So we got Tracey here with Hancock Whitney. Tracey, thanks so much for joining.
Good morning.
So what's an escrow account and how does it work?
So chances are, if you've bought or refinanced a home ever, you've had experience with an escrow account. An escrow account is a non-interest bearing account that the mortgage company or the lien servicer holds on your behalf, that houses homeowners insurance, property taxes, and possibly flood insurance if you're in a high-risk flood zone.
So basically kind of works out kind of like a forced savings account.
Yes, exactly. So the way that escrow is set up, specifically on a purchase, this is where it typically gets a little confusing for borrowers, because wrapped up in your closing costs and prepaid items is your first year's insurance premium, and then anywhere from 2 to 3 months of homeowners insurance and property taxes. And most people say, wait, I thought I'm paying that in the monthly payment. Why am I paying it up front too? And the simple explanation is, let's say you are buying a house and you're closing in March. Well, you're going to occupy the house in March, so we need to make sure that you have insurance. You're not going to have a mortgage payment in April. Your first mortgage payment is going to be due May 1st. So by the time December rolls around and that tax bill comes due, you have to make sure that you have at least 12 months for taxes set aside to pay that tax bill. Okay. Same thing with homeowners insurance. So next year, the homeowners insurance bill will be due in March. So you have to make sure you've accrued 12 months via the mortgage payment and the escrow account to pay that bill next year.
And that's set up for closing. So
right.
What ends up happening, yes, you basically build like a little buffer in, and when those taxes are due, you're always paying property taxes in arrears, meaning
right.
We're going to pay for 2025 taxes in December, and then you're going to pay for insurance up front, because like Tracey said, when you move in, there's no payment for another month and some change.
So you need to make sure you have coverage.
You got to make sure you've got coverage.
Yeah.
So you pay for insurance up front and then taxes in arrears.
Right. So I typically tell my clients, think about your auto insurance, right? You don't pay it after you need it. You pay it in advance. So it's similar. But that's typically the confusing part for clients, is that whole escrow account.
Yeah. Absolutely.
And same thing with flood insurance. So if the home you own or you're buying is in a high-risk flood zone, and if it requires flood insurance, then you have to escrow the flood insurance also.
Correct.
Yeah. So whenever you put at least 20% down or have 20% in equity, you don't have to have an escrow account. You still can. Most people do. It's just easier to have that paid within that monthly payment, as opposed to coming up with that big tax bill at the end of the year around Christmas, or that big insurance bill. Sometimes they both come at the same time, which can be a lot.
Yep. So, one of the things that, I guess the offset of that is you get 10 to 11 months or you get a year of cheaper house note, but it all works out in the end.
Right. And when you pay your insurance up front, that full premium, it's cheaper as opposed to paying it semi-annually or once a month. You actually get a discount when you pay that insurance premium 12 months in advance.
So why would mortgage companies or banks want us to escrow our?
Because it guarantees that the taxes and insurance are going to get paid on the property, and that the property is protected by the insurance, and that you don't get a tax lien on the property.
The only lien that can jump in front of a first mortgage is a tax lien. So,
and speaking of taxes, so whenever you buy, taxes are prorated. So the seller is always responsible for taxes from January 1 through the close date, and the buyer is always responsible for the close date through the end of the year. So by the time you get your preliminary closing disclosure, or maybe like a second loan estimate, you should see that tax proration built in. Basically, it's a credit from the seller on your behalf to make sure that you don't over escrow or pay too much towards your escrow account.
Perfect. Yep. So over 20%, you've got the option to be able to forfeit escrowing the account.
You can waive escrow if you have at least 20% equity.
Yeah, waive is probably a better word for it. So Is there a benefit to escrowing from the interest rate?
Right. Sometimes, most of the time, almost all the time, depending on the file profile, it may cost anywhere from an eighth to a quarter to waive escrow.
So you're basically, what ends up happening is you pay more per month for the opportunity to not have the bill on there for later.
Right. Yes. And it's a one-time cost, but yeah, it does
It's
cost to
not on,
waive.
it's not over and above on your current rate, correct?
Right.
So if I'm at, 7 and it doesn't bump me to 7.125.
right, it's the pricing behind
It's
the
the
rates.
pricing
Mhm.
behind it. So
Yeah. So your rate is affected by it. Just to be aware.
of course,
Yeah.
obviously, when we talk about these things, when it comes to rates, it's going to be a basic, big, broad generality. So if you've got questions about what your escrow situation happens to look like, of course, you can always reach out to Tracey. Where can they find you?
Yeah. Tracy.lasair@hancockwoodney.com.
We will see you next week.